Hey everybody, welcome back to Tech Tune Up with Paul Meeks. I'm obviously he. I'm here with our director, Aaron Thomas, and we're both supported by Benzinga. Remember, take a look at Benzinga tools. I do super helpful. So as you know, what I do every time is talk about individual companies and their shares and not just rehash the news, tell you what happened, quick summary, tell you why it's important to set company. And also, all these companies are in somebody else's supply chain. What are the indirect implications? So let's get to it. The first stock I want to speak about is, and I made a very good call here, another artificial intelligence pretender. Just yesterday, I was warning people about this slug called Big Bear AI, ticker symbol BBAI. Just like I warned with a lot of success a week ago, this other AI company called SoundHound, ticker symbol SOUN. So Big Bear reports their earnings last night, and take a look at the stock price today. They've lost 1/3 of their market cap. And I wish we had this show yesterday so you could have put a short position on. But this is my feeling. If you want to invest in AI, and of course I do, everybody wants to, you have to, until I tell you differently, just invest in the infrastructure plays, which are some of the hardware vendors like a Supermicro, SMCI, and the semiconductor vendors that are allowing the population of these large language models, chiefly NVIDIA, AMD, and a stock I'm going to introduce today on the Meeks list, Broadcom, ticker symbol ABGO. So there'll be more opportunities. A couple of these really squirrely AI companies, particularly smaller caps, will get hyped up by their investment bankers, and then we will absolutely destroy them and make a lot of good dough. The next stock here, company called GitLab. Why do I care about the quarterly report of such a small company that most Americans, even tech investors, have never heard of? Well, GitLab is interesting, and it's a real indirect tell because GitLab is a software vendor that actually has software that helps other software developers create their own. So if they're showing a slowdown in sales, if they're showing troubles, wow, software developers all over the place, pulling in the reins. This is an important tell from a company that few people have heard of. Next, I made a really good call because this has been on my Meeks tech list here on Benzinga for many weeks, ever since we started. My favorite play in cybersecurity is CrowdStrike, ticker symbol CRWD. Now, some people got scared out of the cybersecurity space a couple of weeks ago when its key competitor, Palo Alto Networks, PANW, released some pretty poor results and gave some pretty lackluster guidance. That stock got smoked. People thought, okay, the industry's in trouble. We're going to pound on CrowdStrike. And then the next week, my buddies, my favorite stock in the space, they have a wonderful quarter. They have a bullish forecast. What is Palo Alto Networks saying? Can't be true. Somebody's lying. And the next day, the stock that we've been promoting here on Benzinga is up 26% in the very next day. And you know what? It's still on my list after the move. Next stock to think about, Palantir. Palantir, ticker symbol PLTR, is a company that I haven't been bullish on. It did have a little bit of pop last week because they signed a contract with the U.S. Army. You may recall this is a data analytics company that mostly serves the spy networks like the CIA. Of course, the U.S. Army is a big customer. I will tell you, this is another squirrely company. It's another hype story, and I would sell PLTR into the strength. Next, everybody's favorite tech leader. Unfortunately, it hasn't led in a long time. It's actually been a pretty crappy stock for quite a while, really ever since last fall. So I can only pile on Apple, I'm sorry to say, because a couple things are going on there. So first of all, They have to pay a $2 billion fine, and that's a lot of money even for them, to the European Union because they've been wrapped up in antitrust accusations with their music streaming service. And if you thought that was it, it's gotten even worse. In the EU, they're rolling out just this week their Digital Markets Act. And part of the allure to owning Apple over time is its walled garden. Once you're in that ecosystem with all those products that are linked, you can't get out. But here's what's happening with this really important piece of legislation in Europe, the Digital Markets Act, is they're essentially going to take down the walls of Apple's walled garden. They're going to be forced to allow third-party apps in. They're going to be forced to offer through third-party apps alternative ways of getting paid. Man, you know what? If this legislation starts in Europe, but then moves to the United States, it really puts Apple's key investment thesis at some risk. In the meantime, Apple, despite the fact that it's one of the famed Magnificent Seven, hasn't been on the Meeks tech list in a long time for good reason, and that's been a very good call. So the next thing is Tesla, another very popular, at least at one time, Magnificent Seven stock that I hate and continue to hate, and I've been absolutely right to poo-poo this name. So I don't know if you had read this, but China is a really important market for Tesla. And in the first couple of months of the year, and some of this was impacted by the Lunar New Year holidays in China, but their shipments of their vehicles in that key geography were down a lot, and even down more than some of the other players in that market. And so that tells you the market is in trouble, generally speaking, and Tesla seems to be losing some significant market share, not a little bit, but a lot, probably to BYD, which is their key competitor there. And the interesting thing about BYD is they're now going to go after Tesla and the rest of the world, including here in the United States. So that's probably the EV stock to buy, though I've been pretty bearish on this whole EV stuff for a long, long time. They're cool products. Nobody can make money selling them. The next thing is, it's kind of interesting that Tesla wants to add some capacity to their Berlin, Germany manufacturing facility, but the activists don't like that, and they actually are sabotage, violence, physical stuff, that particular facility. So that's really dangerous stuff. And so every time Elon Musk opens his mouth, I think he thinks he's saying smart things, but man, he probably just buries himself deeper and deeper in the hole. I think because he is, even though he might be a madman, he is a tech visionary. If you ever invest with Elon Musk again, wait until SpaceX goes public. Probably will go public in the next year or so. And that is the one that I think is legit that you can make some money on. So that's Tesla. Stay away. That's been my call for a while. It's been a great call. I actually think it's still probably a short, even though the stock has been cut in half in a year. Next is Meta, a stock on my list that I like very much. This is interesting. On this program, I've poo-pooed old style media, and I'm very bullish on some of the emerging players. Now, Meta is not an emerging player. It went public in 2012. But this is very interesting, and it shows you in favor of Meta, a real death knell for old media. So Meta has decided not to re-up contracts it has had with some news vendors because it no longer wants to buy or license their news copy, because they tried to put links on the news feed for Facebook subscribers, and it seems like nobody cared. Nobody was clicking on that news tab, and they're just going to offer you that data some other way. Very bad news for the old school media companies that were hoping to enter Meta's world. I've always said, when you want to invest in media, and I'm a TMT analyst, tech, telecom, media. If you want to invest in media, what you do is you have to go with the digital ads, and that is forever going to be an oligopoly with Meta and Google. Game over. no other social media sites. And then also, if you want to attack video streaming, which I think you should do, is don't worry about any of these other companies, even including Disney. I think they're forever troubled. You just hold your nose and buy more Netflix. Only really legitimate ways to invest in the transition from old media to new. So this is kind of interesting that there's a private company. Don't typically talk about private companies because you and me can't invest in them yet. But there is a company that's getting a lot of buzz, and I think they might be onto something. It's a company called Figure AI. And what they have is they actually have a humanoid robot. So it's not just some robot arm in some manufacturing facility, tightening screws on the line. It's a humanoid robot, and it looks legit. And when I see smart people investing in things, I take notice. And this company is being funded by Jeff Bezos, the world's wealthiest person, and the founder and former CEO of Amazon. NVIDIA, God's gift to artificial intelligence, at least today, and OpenAI have all made big bets on this company called Figure AI, humanoid robot. Stay tuned, because if they continue to show a lot of momentum, they will go public, and then we can get in. On the next week or so, specifically on March 20th, a company is coming public that'll probably get a lot of buzz. I think it might be bullshit, but Reddit. Everybody knows Reddit, another social media site, social media platform. They're going to go public on about March 20th. And I will tell you this, as I said just now, if they're coming to the dance with a business model that leans heavily on their social media platform and selling digital ads, unfortunately, they are going to be a flea in this market that'll continue to be dominated by Meta and Google. Now, it looks like they're going to value this company at about $6 billion on the IPO, which is pretty steep. Now, they do have one potential saving grace, and that is they're taking their data from their social media site, licensing it, and then selling it to Google and others to actually use as source data as they build out these large language models. Okay? It looks like they did sign a deal with Google where they'll pay $60 million per year for this privilege from Reddit. But right now, that's a really small portion of their overall business mix. So if that really takes hold, I like it. But as of now, interesting story, small piece. The major piece is, are you going to try to fight with Meta and Google? No way. Snap sucked at it. Pinterest sucked at it. Everybody else will suck at it. It's a game over oligopoly with those two at the top of the class. So what I would say is the investment bankers will hype the hell out of this thing between today and the IPO on the 20th, because that's what investment bankers do. The larger the IPO, the bigger their middleman fee, sometimes up to 7% of the proceeds of an IPO. So they'll tout it. The stock might open up on its IPO first couple of days of trading. It might even rocket. You know, at that point, I start to think about shorting that stock. Next, as another tell, which is super important, there's a data networking company called Sienna. It's been around actually since the internet era of the 1990s. It is a company that sells, back then, the plumbing for the internet. But data networking companies quite often sell the bulk of their equipment to the telco vendors, which they call service providers. Sienna had a horrible quarter. A couple of weeks ago, Cisco Systems, which in the 1990s was America's largest market cap company, but now it's a dinosaur, another leader in data networking, also had a really poor quarter, also had scary guidance, also announced that they were firing a shitload of people. So you guys, Cisco before it, Sienna just this week is telling you, stay away from data networking stocks, no matter how cheap they appear to be. And there looks like there is a real slowdown in spending on telecom equipment. I get asked a lot about other ways to play semiconductors because it has been the best industry within the tech sector. And of course, the tech sector has been smoking the overall market. I would sometimes say, if you don't want to do the onesies, twosies, if you don't want to commit the time that I do to covering stocks, I would suggest a ETF, exchange traded fund, for the semiconductor sector. And why not SMH? I mean, SMH this year is up 34%, and you're still going to get your NVIDIA exposure because 27% of the weight of this particular ETF is NVIDIA. So not a bad way to play it. A industry within the tech sector focused on semiconductors, an exchange traded fund. Exchange traded funds give you broad diversification, and the management fees are essentially nil. So I actually say for a lot of people, that's the best way to go. The last stock I wanted to talk about is the EV maker Rivian. Rivian has been a horrible company and a horrible stock over the years, but it did get a little bump in the last week or so because they announced a new product. But here's what I do with Rivian. I think these EV stocks are uninvestable. If you think they're cool products, buy a Tesla, drive it around, but don't invest in these stocks. I think Rivian, at the pace in which they're burning cash, despite this new purportedly cool product that they just announced, I don't know if this company is going to be around in 2 years because they're bleeding cash. They have about 2 years of cash left, according to my estimates now. I think it's going to be very difficult for them to raise money to plug that gap. And I don't think Rivian will be a publicly traded company in 2 years. If they're lucky, they're bought out by one of these healthier legacy auto manufacturers. So I would sell Rivian into the strength. And if you don't own it and you're willing to short stocks, I'd consider putting on a short position. I might do the very same thing. So that is my wrap up with the stocks, what happened, why it matters to them, and why it matters to other in the supply chain. Now let's get to my tech favorites list. Here we go. I've been awfully good with a stock that's at the top of the list that has been on this list ever since we started doing this program. That's CrowdStrike, my favorite bet in cybersecurity. Most other people recommend Palo Alto Networks. They sucked when they announced their quarter a week ago. CrowdStrike, the next day after it announced its quarter, up 26%. We talked about it here. Micron, US leader in memory chips, are going to have a nice inflection in their business. They will be announcing that on March 20th with their quarter because they will be propelled by AI. I like T-Mobile in telecom. This is one of the things I wanted to say about Google, aka Alphabet. Last week, I put up a yellow warning flag because the stock had been performing poorly, actually underperforming drastically Meta in that space for digital ads. And the technical profile of the stock has got me bugged. The stock is still showing some support at its 200-day moving average, which is pretty important, but in all other ways, technically it's broken down. So I am, at least temporarily, holding my Google shares, but I'm not tempted at all to buy any more. I'm going to, at least in the short term, kick these guys off my island. Next, Microsoft, no brainer in my book. Same thing goes with Meta. Amazon should see improving cloud business revenues, accelerating revenue growth in the second half, and that's the key. I like Synopsys, SNPS, with Cadence Design Systems. They're the oligopolist in electronic design automation software, which is software that semiconductor engineers use to build chips. And of course, the market for them is going gangbusters. NVIDIA, you guys, I know NVIDIA has been my top stock. It's made everybody a lot of money. NVIDIA actually tripled last year, and it's up 40, 50, 60, 70% this year. But today, while we're doing this show, the stock is down 5 or 6%. I think some people are doing some profit taking. I think today, if you don't have NVIDIA yet, because you've been worried that you don't want to buy a stock that's going straight up, I think down 5 or 6% today is a pretty good buying opportunity in NVIDIA, a pretty good buying opportunity. And you hear it here first. Next is another, let's call it an NVIDIA Semiconductors AI derivative. This is Supermicro, another stock I've been very good here for you on. 2 weeks ago in the middle of the program. The stock was down 20% that day. I said, buy it. The next time we aired, stock was up almost 30%, and it's gone up since then. But I will tell you this, Super Micro, I don't think has the same upside as NVIDIA, even though they've both been super stocks. So what I'm doing based on a valuation, if nothing else, is I'm starting to trim my Super Micro position. And I encourage you to do the same. I think the stock is getting a little bit too big for its britches, and it has a valuation of a PE ratio of now about 35 or 40 times. I don't think it can sustain that earnings per share growth in the out years. And so I stick with NVIDIA. I actually consider buying some today. And I would start, even though it was a fantastic stock for us the last couple of weeks, I'd start consider at least trimming. Don't sell all of it, but trim some Super Micro. Last week, I added NICE to the list, also added IAC. Still like them there, of course. They're fresh Meeks picks. But the one that I'm adding today is Broadcom, another stock that is down meaningful today. And I think it was just the expectations for their quarter that they announced last night got too high, because I attended their quarterly webcast. I was very impressed. This company is super well managed. It's a little bit expensive, but all semiconductor stocks are. It does have an AI play. And because the greatest of all the bulls are a little bit disappointed today, knocking the stock down 5 or 6%, if you don't own Broadcom, ticker symbol AVGO, buy it. Or if you own it, like I do, maybe up your position today. A good opportunity. So next, let's get into the tech trends. You know how important the macro is to me. You can't be a aggressive stock investors. You can't own a lot of technology stocks in your portfolio unless you think at some point interest rates are going down. They move in the opposite direction. And so I'm looking at all this stuff. The Fed is not going to give us a formal announcement about rates until the middle of the afternoon, specifically 2 p.m. on March 20th. But Fed Chair Jay Powell spoke to both houses of Congress this week, including to the Senate Banking Committee just yesterday. And in the transcript that I've reviewed, he essentially said emphatically, really for the first time from what I can tell, that they will be lowering rates in 24. Now, do we know when? No. And when they start lowering rates, we don't know how aggressive they will be. But it is happening, a pivot from what we call tight monetary policy, which they've done to rein in inflation the last couple of years, to loose monetary policy, which is very good for the valuation of all assets. So that's going to be happening. That's a real boon for aggressive growth stocks like tech stocks, actually good for stocks in general. But I was very interested in what Fed Chairman Jay Powell had to say yesterday. It looks like the thesis is intact. Next, I'm always looking at key geopolitical events because, you know, my philosophy is the world is globally intertwined. It's getting even more so. And when they sneeze, we catch a cold. I'm really worried about what's going on with the bloodshed in the Middle East. And one of the reasons why, selfishly as a tech analyst, the Houthi rebels are attacking ships in the Red Sea. And in the midst of that, we're badly damaging some very important internet cables that are below the waters, and have knocked out 3 major cables thus far that has really hindered the net connectivity in a couple of countries in Asia. This is a big deal, these underwater net cables. So stay tuned and don't just be parochial and think, you know, USA, USA. You can be a patriot. You can follow world events because, you know what, as an investor, particularly in the tech sector, you have to. I thought this was really interesting news this week that on the very same day, almost system-wide, out go the videos at TikTok, which is a Chinese company, and our own Meta. It's got to be a cyber attack, right? To have a simultaneous outage of the social media of two different countries in two different lands. We didn't get a lot of play of this in the media, but I think, it's got to be a cyber attack. I'm pretty scared. And the problem is, as we ramp up the election for a U.S. president on November 5th, we're not going to lower the volume. We're going to dial up the volume, and there could be more of this stuff. I mean, these cybersecurity attacks are very serious. And what's my favorite way to play that as a hedge? It's my buddy CrowdStrike that's been on the Meeks tech list for a while. The other thing I think is very important that was talked about this week is in Europe, the European Union. They first promoted this act 2 years ago, but it doesn't go into effect until essentially now. It's the Digital Markets Act. And as I said before, when I was talking about Apple, the Digital Market Act could knock down Apple's walled garden because they've identified 6 global gatekeepers: Apple, Google, Meta, Amazon, Microsoft, and ByteDance, which is the Chinese parent of TikTok. These are the 6 gatekeepers. And they're now going to have to allow their customers to access third-party apps within their walled gardens. And also, if they do an in-app purchase, they're not just going to have to go to Apple Pay. They might be able to go to, again, third-party vendors. This is a real significant change in the business model of these gatekeeper companies, 5 which are American and 1 which is not. And I think it most immediately and most thoroughly, in a very bad way, could impact Apple. The next thing I think is interesting that came out this week. I've been poo-pooing a lot of these AI companies. I told folks to short SoundHound. Awesome. Made 30% the next day. Then come back with shorting Big Bear AI. Same thing. 30% the next day, which is today. But one of the things that's really bothered me is take a look at Google this week announced that their Gemini AI chatbot, actually, they had to shut it down shortly after introducing it because it's supposed to take text and create images. But the images that it was creating were wrong. Sometimes just totally out of place, sometimes even racist. And then Microsoft has had the same problem with its image generation figure with its AI Copilot software. So here's more evidence. If powerhouses like Microsoft and Google can't do AI right, can AI end up really being the big catalyst everybody thinks it is? I am not sure. I think that AI will be ubiquitous, which means it'll be in everybody's product. That's great. Just like, a broadband internet connection was once rare and now everybody has one. But you know what? Most people don't make money from these things that essentially become utility products. So I say in AI, stick with the infrastructure builders, the guys that are building those large language models, right? And the cloud vendors that have the data centers that are building that are supporting the building of the large language models. Hardware, data centers, semiconductors. In semiconductors, NVIDIA, AMD, Broadcom. Cloud vendors, Amazon, Google, Microsoft. Rather than making a bet on any of these software apps that seem to be so problematic at the release, they're actually going to be big players. Now, the last trend, the last announcement, again, back to the geopolitics that I think is super important is the Chinese announced just this week a $27 billion US fund, which they're calling the quote unquote big fund, to get aggressive about developing and manufacturing semiconductors within their borders instead of depending on us. Now, you may recall a year or so ago, under the Biden administration, we had the CHIPS Act, and we threw in the United States $52 billion at the same issue. But anyway, you're starting to see a bifurcation. We have the 2 biggest economies of the world in a brutal technology standoff. I don't think it's good. And this is a real scary message that we have sent them and they have sent back to us. And stay tuned. I'm actually no fan of this back and forth. Some people are. I'm not, because I see how it could potentially devastate some of these tech companies. When you're a U.S. company that in the past has had an extraordinary percentage of your sales, profits, and operating cash flow come from the Chinese region, then it goes to zero. Worrisome, really worrisome. So that's what I have for this week. I'm Paul Meeks. I'm going to be back next week. Stay tuned. We've had some great picks, both on the long and short side, ever since this program had started. I'm with my buddy and our director, Aaron Thomas, and we both are supported by Benzinga. If you wanted to hear more about me, see more about me, check out my company behind us, Harvest Portfolio Management, down here in the Bayou in Charleston, South Carolina. Until then, we'll see you next week.